Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. There's one subject we've alluded to several times on the Investment Trust podcast this year, and it seems like a good moment to do a deeper dive into that subject. It is very topical, and that subject is gold and other precious metals, which have been very strong performers this year. So I'm delighted this week to have a chance to talk to Keith Watson and Rob Crayfourd, who are the co-portfolio managers of Goldren Prospect Precious Metals, ticker GPM, an investment trust which is quite small, has a market cap of around 75 million, but is right up there amongst the very best performers this year, up well over 100% and nearly 150% as we're recording. We know that the gold price, which is a big factor on the performance of mining companies, has been very strong for a number of years. But the share price performance of this particular trust has been even stronger over the last many months. We can come on to talk about some of the reasons why that is so in a moment. But first of all, perhaps I could ask you, Keith, to give us a 1-minute synopsis of what Goldren Prospect Precious Metals does.
Thank you, and thanks for having us on. Rob and I run a few investment trusts focused on the resources space. This is one of them. It's a closed-end trust focusing on precious metals, and it gives us a remit to invest anywhere around the world and anywhere in the capital structure of companies. The crucial benefit of having the closed-end company structure is that it allows us to invest in securities that would typically be off-piste for your more generalist investor that is typically constrained by liquidity. For us, that sweet spot, well, if I look back, say, a couple of months ago, it would have been, say, 300 million up to 3 billion. With the moves that we've seen in both the gold price and the equities, more recently, that's probably up by the sort of 30 or so percent. Now, that's not really necessarily what people would consider small cap in a UK context, and we'd like to get that message across. I think the other factor to bear in mind is that we're focused. I'd say the top 10 holdings are something around 60% plus of the overall portfolio. And Rob and I tend to focus on projects that will be in production, even at the exploration end. But we roll our sleeves up for investors to investigate opportunities around the world with a focus on value, which we see is most obvious in the off-piste area that I alluded to there. You know, things that larger cousins would be incapable of investing in, with a view to looking at some of the news flow that will act as a catalyst to get them onto that radar and see some strong momentum continued as the big investors come onto the register of these companies.
So as you say, you're investing in gold and other precious metal mining companies, and they are looking to benefit from the increase in price that we've seen and also any new discoveries or developments they might be working on. But what percentage of the portfolio is actually focused on gold as opposed to the other precious metals?
We're about 90% gold. We've got some silver in there as well, and a little bit of PGMs on the side. But I think that is the main thrust of this trust. We've got a little bit of gearing, and I just remind investors, we'll come back to it probably, but that in this trust, come the beginning of December, if you are a shareholder, for every 5 shares you own, you will also get the right to buy a new share at, I think it is 48 pence. So you have an embedded right in that, and that is another advantage, I think, in buying this trust overall.
So if I come to you, Rob, obviously this year we've seen the gold price perform very strongly, and as it has done for several years now, well, at least since the Russian invasion of Ukraine, and also since we saw a resurgence of inflation. There are lots of reasons for that, and we can talk about those in more depth. But this year, the gold price is up between 35 and 40%, depending on what your currency you're looking at. But your shares, as I mentioned, are up more than 100%. This is what you normally would tend to see in a rising gold market environment if you invest through mining companies which are geared to the gold price in a number of ways. But it has taken quite a while for some of the miners to start moving, I think, to catch up with the movement in gold itself until very recently. What are the reasons for that, Rob?
Yeah, look, I mean, I think that's definitely the case. Yeah, look, sentiment towards the sector has remained surprisingly sanguine despite the fairly bullish run that we've had in the gold price. And only recently have we really started to see the equity starting to outperform. So, yeah, we've been repeatedly trying to tell people that that's our view, that actually the stocks have been ultimately lagging this move higher in the gold price because they haven't been showing the operating leverage you'd typically expect to see. Fast forward to where we are in the last 2 or 3 weeks, then we've definitely started to see a bit of catch up on that as sentiment is starting to shift a bit more positively. So rather than just seeing this a one-to-one relationship, for example, if you produce gold at $1,000 per ounce and gold's 2,000, when gold goes to 3,000, effectively your margin doubles, albeit at a 50% increase in the actual gold price. So, that's what we talk to when we're saying operating gearing. And ultimately, sentiment does feel like it's starting to shift a bit more positively, but off a fairly low base and against the backdrop of some very strong price action in the underlying miners just recently. So there's a number of reasons for that, but ultimately, if we look at stocks now, we think they're at very attractive levels, certainly not stretched valuations, even with this kind of move higher that we've seen. And that's even from the larger caps. And if you move down to some of the more mid tiers, that we see some more attractive valuations, and certainly where this trust focuses, that we really think we can get some very attractive value opportunities. So we can often find names that are kind of trading more around that 0.5 times price to NAV, with free cash flow multiples up in the high teens and still providing significant amounts of growth, which we think is a key catalyst towards a re-rate going forward. So yes, with some very attractive levels on the companies that we're looking at, despite what has been a relatively strong move for the sector, we definitely think there's further to go for the underlying miners in this backdrop.
Okay, so your story is that if anybody's interested in looking into this particular area, it's not too late to get involved. Of course, one factor that may be relevant is how long the gold price can stay where it is, and indeed whether it's going to go on any higher, because obviously it takes time for the impact of higher prices to feed through into the industry. A lot of what's been going on in the gold price, according to most observers, is being driven by central bank buying rather than by exceptional demand from other sources. That too may be about to change. What do you think has been the factors that's been driving up the physical gold price, and why are you confident that it will actually stay around these levels or even go higher?
Well, I think that's a really pertinent question. And one of the things we really focus on is flows and kind of seeing where the incremental buying is coming from. So yes, your point is exactly correct. A lot of this run up has been primarily driven by central bank demand. And if we take a look back in history of what was the key driver to that, so in the post-COVID period in 2020, we initially saw a ramp up in gold price, and then the miners gained stronger margins, but ultimately gave much of that back as they then saw cost inflation. So that kind of led to the price increases that we saw for the companies themselves, but ultimately a lot of that was then given back. But then as we move into 2022, we then saw the Russian invasion of Ukraine. And that then led to a real pickup in central bank demand, with central banks having been buying about 1,000 tons per year as at that point. And we think that was the primary driver of the gold price that saw it get up towards the levels we're at now. And only recently have we started to see increased participation by financial players. And we look to the physical ETF holdings as the key indicator for that. And year to date, we've started to see that ticking higher, but still, as we speak, getting close back towards that post-COVID period. So the sentiment in the miners themselves has remained fairly lackluster, only just starting to catch up. But the central bank demand is far stickier. So that demand that we've seen, which we expect to continue, primarily driven by the broader dynamics of, post the Russian invasion of Ukraine. The concern there was around the US weaponization of the US dollar. And that's led to steady treasury selling, which has seen the likes of the Chinese central bank, for example, holding large amounts of gold. We're now in a backdrop where we've got a global trade war, primarily US-led, with tariffs being implemented. So our belief is that that will lead to further central bank demand over and above what we were already seeing from the weaponization of the US dollar. But the thing that really excites us is the lack of participation up until recently from financial players. And we think there's a very strong justification for financial market participants, so generalist fund managers or general retail buyers, to come in and start to add more gold, where they're generally heavily underweight versus where we've been at historic levels. And we think that's the key driver towards the next leg up in gold. So when we talk to flows, what we've seen so far is the flows have largely been driven by long-term sticky holders, i.e. central banks. And now we're starting to see a catch-up trade in the more generalist investor allocating towards gold. And we think that can really drive incremental demand and see the price go higher, especially against the backdrop that we're seeing on global debt questions and debt sustainability. And that has a real feedback loop into the purchase power of currencies ultimately. And we think we're really entering a new period where the defensive properties of gold are really going to see people allocating towards it as a defensive mechanism in their portfolios. And we've seen the likes of Goldman Sachs coming out and stating just a 1% shift from US Treasuries into gold would see gold up at $5,000 per ounce. So yes, the moves so far have been very strong, but there's certainly reasons to suggest that it could have further to go. And as we flagged previously, that the miners aren't at stretch valuations, and there is certainly further potential for them to keep moving higher.
So, as we all know, the performance of gold miners is always been very volatile, as you mentioned already. Tend to be strong bull markets and then bear markets and so on. There's always a push-me-pulley between the gold price and the cost pressure that you've mentioned already. So, from historical experience, how long do you think this rally in the mining stocks could go on? I mean, are we talking about a year, 2 years, whatever? Obviously, that will depend a bit on what you think about how long the gold price is going to stay elevated. But is this actually different from the cycles we've seen in the past, or is it just a rerun of something we've seen quite a few times over?
If I can step in on that front, I think one of the important aspects to understand is that, one, there is a lot more money sloshing around the system in terms of money supply, looking for a home, and a lot of it is passive. If we look at the commodity and the mining sector in the main and take, say, a decade view, one thing that is most noticeable over that period of time is the lack of investment in new supply. And that's across the board in most forms of what I would call real assets, whether it be copper, whether it be to an extent in things like uranium. I think is probably one of the bigger examples of that. Now that just gives you, even in a slightly weaker demand growth environment, a more helpful backdrop for some sustainable inflation. Now, I think on top of that, we've had completely wonky policies from governments that are in some ways exacerbating that situation. You know, that no one wants to invest in new supply still, but inflation is the real risk, where we've had not just an invasion by Russia into Ukraine, which has resulted in significant displacement of that, but we've had latterly international inward-looking policies, in particular with the likes of the tariffs, adding an extra level of inflationary pressure to things. And the most important thing, though, is to remember that those don't go away quickly. And it's interesting that if we just look at the US Fed, their rate-setting criteria, I think, has now moved away from inflation, even though we've not yet seen the full effects of tariffs because of all of these effective deferrals that we've experienced. And in fact, that's possibly pulled forward some modest level of activity and inflated what would be otherwise even more anemic growth globally. But the fact is, they're now having to face weakening economies. And in that background, we're in a stagflationary environment that may persist for a considerable period of time. So I think, if you jog back the beginning of this year, Rob and I were asked by the likes of the Wall Street Journal, do you think gold will hit 3,000? Very quickly, that's moving to 4,000, and we're now no further forward in terms of seeing the full effect of the likes of tariffs, with a weakening backdrop globally and monetary setting criteria which are paying less attention to inflation. So I think this can continue for a long time.
Okay, so we've got, as you say, concerns about inflation still, which has obviously traditionally been good for gold. And we've got this eccentric, perhaps policy making, we might call it politely, which is certainly not helping on that score. What about an end to the war in Ukraine, if that happens? Obviously, we don't know how it would happen if it did happen. But would that have any significant impact? We know that Ukraine obviously is an important element in the metals market. Does that have any direct impact to the extent that it might perhaps reduce fears of geopolitical instability?
To an extent, but I think things may have already crossed the Rubicon. And we've got to remember that already we've got, say, in the energy markets, a black fleet which is selling discounted oil, which people are trying to prevent. We'll see how successfully, I guess, over time. But by removing that, then we move to parity in terms of the discount levels. But I think on balance, that's probably not as helpful a backdrop if that were to end. And, we are cognizant that that's possibly coming, but it's taken a lot longer to resolve than people probably would have expected. A war of attrition, ultimately. In the meantime, I think every single government, as Rob outlined earlier, is overly indebted. And what they have to do is get growth in order to generate tax revenues to help reduce that. And that growth is proving costly to attain. And in some cases, unless you have a real competitive advantage as a nation, you're going to struggle. So I think that Rubicon might just be already the threshold that we've crossed. And if that's the case, then be very careful of what that means for long-term rates, which if we take, for example, the US, last I looked, it was 36 trillion, I think 36.5 trillion of liabilities. I think their deficit spending, both the one big beautiful bill, something like 2 to 3 trillion a year. We've got the Fed, which still has 4 trillion worth of US treasuries, never mind other assets that it's yet to unwind. And in the meantime, they're going to have to sort of struggle to offload those. They're going to be issuing some number of trillions of dollars just to pay interest on that at the moment. So that, I think, is probably one of the biggest issues in focus at the moment. And I don't know that right now it makes any difference that Russia were to perhaps come to some terms with Ukraine, because the effects have already been felt in that there's a clear issue that everyone's moving more nationalistically. That means more friction, more inflation.
So in several respects, therefore, this is something of a perfect storm as far as gold is concerned, in terms of the things you mentioned. I guess the only one that isn't is the fact that interest rates have gone from being zero to the long end now we're at 5% or so, and real interest rates have gone from negative to positive. Now that normally you would expect would be relatively bad news for gold, but that doesn't seem to be playing out in the current environment. Would that be right, Robert?
Yeah, I think that's certainly right. I think we're in quite a different world. And as you say, sometimes inflation is good for gold, sometimes it's bad for gold, and it depends, because higher inflation can lead to rates going up, and that impacts the opportunity cost of gold. But this is different. This rhymes more a bit like with what we saw in the 70s, where actually you've got high inflation and yeah, you've got sticky inflation. And actually, you're kind of stuck with trying to reduce rates. So if you have rates coming down and sticky inflation, that's obviously the perfect backdrop for gold. And let's not forget, gold went up 13 times in the 70s. Yeah, there was a bit of a sort of Bretton Woods kind of aspect to it that had some nuances to it. So I wouldn't say it's a like for like or cool that the same could happen here, but there's certainly some nuances. But we focus it more from a sort of flow aspect. So, we talked earlier to central bank demand having been the primary driver. We think financial players are now coming in, and that's primarily coming down to, as Keith was discussing there, around debt concerns. And no one's going to claim that the US is ever going to go bankrupt, because they can't, because they can print money infinitum. But what it does mean is you get currency devaluation and purchasing cost, which is a circular mechanism, which if you have devaluing currency, you end up effectively stoking inflation just as a result of it in a devaluing currency. But in that backdrop, we really think gold as a form of wealth preservation is hugely relevant to a broad array of investors. And at the moment, we're looking at it, and if you look at physical gold ETFs, it's only got total value of around $300 billion, which sounds a big number, but it's actually tiny, and it's less than 10% of Nvidia in perspective. So yeah, it's kind of 0.1% of global financial assets. And we think investors are broadly underexposed to gold and seeking protection. And with that backdrop around what is the value of the currency that they hold, we think there's a massive justification for allocating more towards gold. And Goldman came out with some numbers just last week saying if 1% of US treasuries were to rotate into gold, that would see gold at $5,000, to put that in perspective. And we certainly know that the Chinese and other foreign states are clearly focused on reducing down their treasury holdings and increasing gold, which is under zero influence of any other foreign government. So there's a clear incentive from both the government level and financial markets fund perspective. So I think we could see more allocation that way.
So I guess the question that will be of interest to some is this. Obviously, we've seen this rally in gold mining shares, but suppose that the gold price, which as you say, could go to 5,000, but suppose it stays where it is, have we actually seen all the catch-up that we might expect from gold miners? In other words, does it need higher prices for this rally to carry on, or is it actually still going to be positive and indeed generating cash flow for the producers anyway, if gold stays where it is?
Very definitely, it will be continuing to produce very, very healthy cash flow yields that Rob has referred to, in the high teens, if not higher, in some of the equities that we look at. And the other factor is that I think, referring back to the participation of the wider funds, I just don't think that passive money really yet sees it on the horizon. They're far too busy bickering about whether or not there should be an extra 1% in AI versus whether or not they should be in a gold index, which maybe represents about 5% of the index in Canada or perhaps Australia. And that's a large proportion of the index in total. I just don't think the pain of being out of it at the moment is enough. And that's something that, in the context of the valuations that we referred to, which in the current gold price environment are extremely attractive, means that we could see sustained performance from the equities.
Okay, so just then finally on the bigger picture, in terms of the currency, obviously gold is priced in dollars and the dollar's been weakening. So that plays to the advantage of people who are investing from a stronger currency perspective. What's your position in the trust about your exposure to the dollar, and how do you manage your currency exposure?
We don't take any kind of hedging view. So clearly the reference currency is sterling, and the majority of our investors are UK based, so would view it in very much sterling terms. So if you do get kind of swings in currency, there is a direct read through. But what I would say is the miners themselves operate on a global basis, and it's effectively a dollar system because all commodities are sold in dollars and costs are denominated in the country in which you operate to at least a large proportion, such as labor, etc. So for a typical miner, you might have 50% of your costs being dollar based and 50% being local currency. So whilst you might look at it and say on a reference back on a currency basis, there's a negative impact, that can actually be a positive in that it reduces the costs for the producer in that country. And that's what matters to the equity valuation. It is the margin that they ultimately make and earnings that are generated. So there's a sort of natural balancing effect within that. The key risk, I guess, from a currency perspective is massive swings in sterling versus other global currencies. And that's something investors should be aware of because we aren't actively hedging that out. But I kind of see more reasons why sterling might weaken rather than strengthen from here personally. But people can take their own views on that, and they should factor that into viewing this fund as whether it's an appropriate investment for them.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Of course, I never met anybody who invests in gold mining shares who wasn't in some sense an optimist. That tends to go with the territory because it is such a volatile thing, and there's always glorious periods followed by periods of great disappointment. But what sort of numbers or metrics would you say, looking across your portfolio, that the miners that you own are cheap? So if we just take the producers first of all, what kind of multiples are we looking there in terms of, if you make certain reasonable assumptions about future prices? Are they cheap historically or not cheap historically?
They are still cheap historically. So to put it very loosely, despite the run-up we've had in the miners as a sector, the larger cap miners kind of trade around 0.7 to 1.5 times price to NAV. If you go back historically, gold miners typically traded at around sort of 2.5 times NAV because of the insurance properties they provide. Separate question whether we think that's justified. And then if you go to the next tier below that, and that's your more $2 billion, $3 billion type market caps, we can find a lot of names that trade more around the 0.6, 0.7 times NAV. And actually, we think they are actually more attractively valued than that because they have growth that is not being fairly attributed by sell-side research within those numbers. And then if you go to the next tier below that, which is maybe a single asset producer, you can often find 0.5 NAV with a growth asset that we think is undervalued, so we can kind of see material upside. So double-digit free cash flow is relatively easy to find still. It's certainly not suggesting that valuations are overly stretched, and it's looking crowded by any stretch in our view. And that's one of the reasons why we're saying to our earlier point why, yes, it's been strong, but in no way do we think people have missed it, because I think that can be the first reaction when you see quite a quick market response such as this.
Okay, and in terms of geographical exposure and by type, so what percentage of your portfolio is represented by producers versus developers versus explorers? And in terms of geographical diversification, what does that look like?
If I jump in there, I would say by far and away at the moment we're into the producers, and this is something which can vary over time as well. If you jogged back, say, more than 5 years when we were in a low-cost environment, we were more in developers because there was less risk of suffering cost overruns and delays because supplies were available. Things like tariffs have come in, steel cost and of steel availability, oil prices and energy costs had certainly moved up quite heavily during the post-COVID reflation and then Russian-Ukraine war. And we saw actually some of the developers that we had invested in and continue to support become producers. But for the time being, we still think that the better value and the risk reward is perhaps skewed into the producer side of things, which represent something like 70 to 75% of our current AUM. If we look at developers, it's probably about 20%, and explorers will be the balance. And we've rotated into explorers earlier this year and at the back end of last, which were hugely crushed. No one wanted to know. And now actually they've had such good performance, certainly over the last couple of months, that if anything, we're taking a little bit off the top there and putting it back into the producers, which have in relative sense lagged that. So, we're doing some of that rotation for investors just to lock in some effective risk reward profile that we see there. Geographically, I'd say we're moving back more into North America, in particular Canada. And it's probably, I'm trying to think what that number would be regionally. I'd guess it's something like 60+% Canada, probably around 25% Aussie list, and the balance would be, at listing is probably even higher Canada. Asset exposure would be something more like 50% Canada, 25, 30% Australia, and the balance will be something in Africa or elsewhere around the world.
We haven't yet talked about silver. Now, silver has obviously not kept up with gold in its performance. And I think if you're a gold bug, you tend to look at silver ratio to gold as well. Do you think that there is the same or even greater exposure potentially by investing in silver or silver miners?
So I think probably more than ever, they're actually very different in their drivers. And the key difference now is that we're over 50% industrial demand in silver. So, silver is the only metal that's a better conductor than copper. So it's used in high-end electronics. As a result, you're slightly beholden to some of those cycles. And actually, if we look at that from a demand perspective, it's actually very encouraging in that, you probably want to be linked to the future growth of EVs, wind turbines, general high-end electronics, or we're certainly feeding through into chips, etc. So you've got that aspect that's a driver. But from the demand side, we have the most conviction around the stickiness of central bank demand for gold. Clearly, silver doesn't play into that thematic, where the demand side from a financial perspective is far more kind of speculative and more retail driven. So we do know it's a much smaller market, it's less liquid, and you can get some real outsized moves. And if gold goes up, generally you do get silver going up as well, but it's slightly different drivers. So yeah, I think because of that more speculative aspect to it, we do have a slight element of caution around it, although we are enthused about its direction. The reason we're not larger in weight to it, because we do see that upside optionality that it can provide, is actually the miners themselves often trade at a material premium to NAV. Often in more difficult jurisdictions, it can be quite a hard commodity to mine because often it comes in kind of smaller format, it's kind of underground, it can be higher grade. A lot of it comes from Mexico, which had its own kind of political issues around mine security. So it's kind of justified whether you really want to pay such a premium. So that's probably the key reason for why our current weighting at a bit over 10% or 13%, I think it was as per the last fact sheet, isn't larger. It's more from the bottom up valuation side. But yeah, it's a level of conviction around the demand side as well. I think there's more of a speculative component to silver.
And what are your ambitions for the trust? Obviously, the share price has been very strong, as you've said. You typically, I think, trade at a discount, and you're still trading at a discount at the moment, single digit, roughly speaking, I think. Do you think you could actually grow the trust sort of in terms of share count as well as in terms of simply a return to your investors? What are your thoughts on that?
That's absolutely the intention with all three of our trusts, including Goldren Prospect. And I'd say, that the discount does narrow even more when you look at the fully diluted NAV that arises because we've got an embedded right, so that for every 5 shares you hold, you'll be able to subscribe for one new one at a price of 48 pence, and that will be as of the beginning of December that you'll become eligible for that. There's a slight wrinkle in terms of the fact that this is still a grandfathered Channel Islands list, so there's a bit of a cap on that, just to bear that in mind. But nevertheless, that will be something that is so in the money that will grow the share count. But ultimately, we really want this and believe it is capable of getting back to a premium to the underlying net asset values. And that will allow us, at the correct sort of level of premium to cover costs, grow the share count on an ongoing basis over and above that embedded right.
So just to be clear about the embedded rights, effectively the share price is now, sort of 82 or something like that. So you would be able to buy an additional share or get an additional share at a price of 48. That's effectively what you're saying.
For every 5 that you hold, subject to the issuance limitation that is imposed by the Channel Islands list. So at the moment, it would probably be just slightly less than that on average that will be netted out as new issues of shares. But nevertheless, it's growth in the trust. And, we have to swallow some dilution that results from it, clearly as per the NAV. But if we jog back to 4 years ago, the size of the trust was such that actually we had to consider growth including potential dilution that would arise from that, because we needed to. And if you've had those shares and you are eligible for the new equity, please take up your rights. You're not diluted on that basis. And, that's the ultimate aim of that particular program. But really, I think we just feel that this is now a sector which is becoming much more of a focus in the investment markets and has the ability to trade at a premium to net asset values for, the first time in a long time, frankly, in the commodity space. And I think certainly by virtue of the valuations that are out there, I think it's a very cheap form of portfolio insurance. And, you don't have to go all out into gold. You just need to protect your wealth and have an allocation to it. And if you're getting a fund trading at a discount, even to the diluted NAV, which you can subscribe to maintain your ownership without suffering any dilution, so much the better.
Okay, so that's an interesting feature of this particular trust. Perhaps before we kind of finish, I could just ask you mentioned you have 3 vehicles that are managed by your management company. Perhaps you could just explain what the difference between Goldren Prospect, Precious Metals is, and the other 2.
Yeah, so we run the 3 trusts. So we've got Goldren Prospect, obviously. We've got CQS Natural Resources, which is across commodities. So that does energy and mining. What I would flag with that is we currently have around a 50% weighting towards precious metals. So it shows our conviction in this theme, not just purely within the pure play fund. We actually see that in the fund that has more discretionary exposure. So it really does highlight that conviction. And then we have Geiger Counter, which is a uranium mining focused investment trust. That obviously plays through into the big nuclear thematic, and we've seen that gaining a lot of support, both politically and publicly, as the only form of zero carbon baseload power. Is getting a lot of support around potentially being an energy solution into the big build out of AI data centers, into what was already quite a tight market. And we think there's some very strong fundamentals there on a decade or multi-decade view as well. So we feel quite fortuitous. We're running 3 trusts that we think are all very well positioned into some very interesting market dynamics, and see some great opportunities across them.
Okay, so I think that brings us to the end of this. Unless there's anything you want to add that you want to emphasize at this point, I think we've got the message quite clearly. You think that gold price is not going to correct, at least, and may well go higher. You're saying that the miners still have, in terms of their traditional relationships, have room to do and valuations are attractive. So it all seems very good. Anything to watch out for is it might be too good to be true.
I would say one thing, and it comes down to, again, one of our investment styles is that we like to buy assets which are able to withstand some price pullbacks, which I suspect may just prove temporary. So it's not to say that the gold price won't come down. We've been repeatedly asked that in terms of giving a view on the gold price outlook, but given the relatively attractive valuations, given the fact that we invest in mines which have a very attractive margin, in other words, a low cost of production, they can withstand a temporary pullback. And one thing that we have noticed, certainly over the last quarter, is that dips both in the gold price and certainly to the extent that we've seen them in the actual equities have been bought. And I think that is a telling trend. What we would like to see and we think this is the great opportunity, is that the passive funds, which have just been effectively momentum players, start to realize that these are a more important part of the index and warrant more investment. And I think that will add a completely different leg, akin to the incremental demand for gold and what that would mean for the gold price should there be an allocation of just 1% into that.
Perhaps that just leaves me with a final point then to at least raise in the listeners' awareness perhaps of these things. I mean, what we have to say about Goldren Prospect, it has a market cap, I think it's around 75, 77 million, something like that. Geiger counters around 65 million. And the CQS Natural Resources Trust, which has had Saba Capital as a shareholder, it should be probably worth pointing out, is 197 million. So all of these trusts are under the kind of threshold that most wealth managers, for example, now say that they don't want to invest. But actually, it's perhaps indicative, you could argue, of one of the strengths of this closed-end fund structure, which is that you can invest in specific small areas like you're investing in, and you can do it at a relatively small market cap. So that is an example, if you like, an advertisement for the investment trust sector. You talked about financial investors coming back in, but in terms of the share registers of your trusts, have you actually seen any significant return by wealth managers or rather larger investors, or are you mainly still looking at private investors and one or two specialists for your source of demand?
Interesting question. I would say that at the margin, we've seen a little bit more interest peaked and shares purchased at the institutional investor level and wealth manager level over retail, which have previously been and still do dominate the share register. Hopefully that will continue to drive a little bit more demand.
Okay, on that note, that brings us to the end of this very interesting discussion about gold and gold miners. I'd like to thank you both, Rob and Keith, for taking part. And, well, we all look forward with great interest, myself included, since I have some exposure in this area, to seeing how the gold market and the miners perform from here. So thank you very much.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.